So Alex, at Oxford, at the Said Business School, actually teaches a few things, but one that I think is very interesting for an Australian model is a social entrepreneurship major within their MBA program. Now, we don't have that here yet, but it's certainly something to think about. I thought we'd start by setting the scene and start with the first question, which is, why are we hearing so much about things social? As I've said in a previous class, it's almost as though social is the new green. We've got social entrepreneurship, social finance, social impact bonds, social innovation, just to name a few things. We've also got increased conversation and discussion around creation of social value. That should give our accountants a nice little challenge. And I thought I'd ask Alex to begin by actually giving his perspective on why so many countries are interested in this and what he thinks are the drivers of this emerging and important global conversation.
Thank you. I should say we didn't actually prepare the detail of the question, so this will be really exciting. So that's the first time I've heard that question, but it's a great question. Thank you. Can you still hear me? I should also say thank you very much for inviting me, and thank you to CSI for hosting me while I'm in Australia, and thank you to you for coming along, and I hope it's interesting. I look forward to your questions. So I think there's a couple of things going on in terms of why this kind of interest in the social. I think they are to do with some degree what you might call supply and demand in a very conventional market kind of sense, and that's the nature of the problems that we are having to face globally are at a scale and at a level of complexity that we maybe either haven't had before or that we haven't fully appreciated before in the way we do today. I mean, there have always been pressing social and environmental problems, of course, but maybe we face greater problems than ever, or at least we're more aware of them. And I think these really difficult, what some people call, I said the wrong thing already, sorry. Somebody's leaving already. Let me finish the first question, please. I think some of these, what some people call wicked problems, some of you might have heard of this idea of wicked problems, problems that don't have an obvious solution, or perhaps don't have any solution. You can only ever have a partial solution. So think of climate change being the obvious textbook example of a problem so complex that it's hard to see a single solution. So we've got these wicked problems, these complex problems, and they're demanding us to think about, on the other side, perhaps new responses to them, because at the same time as our understanding of these terrible problems has increased, and the scale of them maybe has increased too, the institutions that we've relied upon to deliver solutions to these kind of questions, which I guess conventionally have been government and civil society, and maybe to some degree corporates through kind of corporate social responsibility or CSR, those institutions are struggling to respond. And so I think what we're seeing are the unpacking of problems that are so complex that we're having to understand very complicated responses, what are sometimes called clumsy solutions to wicked problems. And I think in the mix of all this complexity and this lack of certainty about who's responsible, who's going to solve the problem, people are getting concerned, and that's why they're putting words like social in front of stuff. Because they want to remind themselves that, oh, okay, this new type of investment that's trying to bring huge pools of global capital into areas of activity where they wouldn't normally be placed could be a cause for concern for some. So let's call it social to try to begin to frame it in a way that might make some sense to people. Social entrepreneurship, another. Because you can see in a lot of these phrases, social innovation, we're getting two ideas that maybe don't naturally sit together, at least historically. Investment being social, entrepreneurship, you think of that as being very Silicon Valley, kind of sole entrepreneur aimed at huge financial return, being social. Innovation, maybe not in the conventional charity sector, we might think. So part of it is a way of, I think, just framing and contextualizing some of this change. And the change, I think, is because complex problems are demanding new solutions that conventional institutions, let's be quiet, conventional institutions and or fridges are not addressing in the same way they used to. I mean, that makes sense? Air conditioning.
No, I think it was the coffee machine. Anyway.
Hands up for the debate. Hands up for the coffee machine.
We could disagree.
Okay, yes.
So, how would you explain then, in your words, what you've referred to as the blurring of the traditional boundaries to reconfigure markets in this new context?
Okay, well, it builds on, I think, what I've just said, which is, you know, to some degree, at least in developed liberal democracies, we've grown up thinking of three kind of pockets of activity in our society. We think of the state, the formal democratic government structures, we think of the private sector, typically encapsulated in the firm or the big corporation, and we think of the rest, which is civil society, and sometimes is the negative, the not-for-profit. You know, we see it as the other thing. And if those three sectors ever really did exist in those pure forms, they quite clearly don't anymore in developed economies in the West and North anyway, I'm sorry, the South, forgive me. I'm used to saying this to a different audience, developed economies. Because we're familiar with public-private partnerships, we're familiar with corporate, not-for-profit relationships, we're familiar with the private or civil society sector delivering what would have been government statutory services historically. So there's a lot of blurring around these boundaries, and that's part of what I think we have to generate innovation to get at these wicked problems, because the conventional institutions are struggling to do this. So the market piece is simply is related to that for me, in that I'm really sick of the idea that when we talk about markets, we talk about it in an unbelievably narrow sense. You know, you say market and we think of kind of the stock exchange. You know, we think of the London Stock Exchange or New York or Sydney or whatever it is. You know, and we think of a very narrow bunch of, you know, financial markets that are represented in a certain way in the media and the press and by governments. And that, of course, is a fraction of the real market activity that goes on every day around the world, which is not just in financial markets, but is in lots of other sites of exchange. And if we go back to what market theory is, all that means, all the market is a meeting of supply and demand to put a price on a value. That's all the market is. It's as simple as that. It's the basis of market theory. And if you think about that, that applies to lots of interesting areas of social provision and environmental protection and provision, lots of other areas that are not just about stock exchanges. And so I want to some degree, in my own very humble way, I'm not that humble, but I don't want to pretend I'm an overachiever. You know, recapture some of that market discourse, if you like. What are markets? And remind us that they have different definitions than just a very narrow one.
Yes, and what about the, you know, the work of Muhammad Yunus and others in reframing for our thinking the notion that the poor can actually be a viable market?
Absolutely. Well, in that case, I mean, so when we think about innovation in this space, or perhaps in any space, there are different degrees of innovation. You know, I'm happy to see innovation just at a product or service level, or innovation at a market level, or innovation at a kind of systems level. And kind of what Yunus did was work through all three pretty rapidly. So he began with a very simple piece of kind of product innovation, which was that he personally gave $26 to a small group of Bangladeshi women who couldn't access any kind of loan finance, and then learned that they repaid that money at 100% repayment and made money on the back of it, because contrary to what people thought in 1970, the poor are very entrepreneurial, almost by definition. They have a great incentive to be entrepreneurial, right? More than most of the rest of us actually have. And he built that into a market and proved that you could develop microfinance as a market product, and in due course, I think, got to the systems level, and to some degree anyway, transformed the way we think about the poor with respect to investment and economic development. And so he kind of worked through all three, and I think when he kind of got to the third, that was ka-ching, time for a Nobel Prize, right? And that's why he got that. So he's a good example of, I think, how you can go through all three sort of stages of innovation.
And what about Victoria Hale and One World Health in attitude to the poor as a market there for pharmaceuticals, the government?
Yeah, I mean, I don't know if you know any of you know the Institute for One World Health. So this is Vicky Hale's organisation, and it's a really interesting bringing together of some of these, what you might have thought as separate sort of entities or institutions. So So the genius of her idea is simply that you have a bunch of tried and tested pharmaceutical products lying on the shelves of big pharma companies for which there's no obvious market because the clients who need those drugs can't afford to buy them. So they sit without any further development. And so this is a classic market failure where you have a demand and you have a product and you have no market to connect the two. So Vicky, using foundation money, largely Gates Foundation money, effectively created the market. She underwrote for the pharma companies the market with foundation money to allow the pharma companies to justify actually manufacturing and distributing these products. Often also, as a footnote, through a kind of generic drug model, so the cost would be per unit lower anyway than it would have been if they'd been fully branded. And so by using foundation money, she's kind of leveraging a bunch of other stuff that's sitting around, like huge investment by the pharma companies in these drugs, which is just wasted investment while they sit on the shelf, and also a huge social problem, which can be alleviated by access to these drugs. So again, that's market making by using philanthropic money, not just to give people a check or to give people a handout, but to make a market that gives them something very useful for their health.
So if we zero in a little bit on the notion of social finance, having spent 6 years in the UK, I must say I was completely bowled over by the dynamism, really, of the conversation that went between those three sectors, blurred boundaries or not, around new ways to leverage money for social purpose. And one of the things that had its origins with the Blair Labor government and has been taken over, that's very unusual in Australia for an incoming government to embrace something that the previous government had on its table. Well, actually, in fact, this was unusual. So this notion of the big society is one such thing, but within the big society is something that started out as Big Society Bank, but is now Big Society Capital. Would you like to just tell us a little bit about how that works? It was even worse than that. It started out as the Social Investment Wholesale Bank. Not a very snappy title, right? So this again, I think, was just smart thinking by people in both policy and the social sector. So there were two big pieces of innovation here. One was the notion that sitting in the bank assets or the asset sheets of big banks were lots of dormant accounts. So a significant amount of money which hadn't been touched. In the UK, the rule was for 15 years. So it had been untouched for 15 years. And so essentially, this was sitting on the bank's asset sheets, earning the money when it didn't really belong to them, or the government argued in 2005, really anybody. And so the government decided it would have it. So the British government introduced legislation to access those dormant bank account assets. Now, it won't surprise you that the original estimates of how much was in these dormant assets proved to be much higher than the amount that came out of the banks once the legislation had passed. But nevertheless, something in the order of £400 million of dormant bank accounts are going to be realised out of the Main Street banks in Britain. And the second piece of innovation is what they're going to be used for. They're going to capitalise an independent, so not government run, social investment intermediary, so a wholesaler. So to be called now the Big Society Capital Project, because you can't call anything a bank anymore in Britain. It's so toxic, so the Big Society Bank had to become rapidly the Big Society Capital. It is a bank, but it couldn't be called that. And so they will invest and co-invest to leverage money into other social investment organisations and funds. So the idea is the 400+ million will be leveraged, we hope, one-on-one, so it'll be, £1 billion sterling, probably, to capitalise the social investment sector, and it will be separate from government, so it won't be subject to policy whim, or the government can't take the money back, because it'll be independent and the money will come from the banks. So I think a lot of people are looking at this. I mean, it's very early, they haven't made a proper formal investment yet, but they are up and running. They've got a skeleton staff, and they've done some initial research around the market they might look at, and I think the impact will be potentially enormous, at least to test the market. Now, we copy quite a lot here. Just a second, Emma. Before we go any further, this is not name and shame, but is anybody from a banking background here? Working for a bank? Would you like to take this idea back with you and just tell people this could be on the horizon, possibly? Because we do in Australia, because of our Westminster system and many common elements of culture, we do tend to look to the UK. Sorry, Emma, what was your question?
I was just going to say there seems to be a bit of a rise in this sort of intermediary, sometimes sort of quasi-governmental.
Can you hear that at the back? Yeah.
And a sort of an approach where you're getting these sort of big fund managers investing in not-for-profits or social enterprises. Will we, I mean, we're already seeing a sort of an increased sort of drive for people to measure their impact, but will that have a big effect on, if these are sort of public funds, we're expecting some kind of evidence, accountability as to what they're achieving? And is that a lot of pressure to be putting on the sector?
I think there's two different questions there, if I may say. I can answer them both if you want, but to the point about what will come with the money, well, it kind of depends who you're talking to. So big society capitals, you know, is designed to be a sustainable financial institution, so it will not be giving money away, or if it does, it'll be giving away a very small amount. It will be investing an amount. So the people it works with will in turn, presumably, also be looking for investments. Now with investments, well, whatever they are, they don't have to be market rate investments, but they need the capital back. There's going to be automatically levels of due diligence and financial regulation about reporting that doesn't go with the grant. So, you know, there's no question that will be the case, because you can't take loans without proper due diligence and proper financial accounting. So with respect to that model, those who want to engage with it are going to have a certain amount of financial literacy and reporting, because that's just the law. In respect to kind of other grant funding through government or otherwise, I think there is a trend to demand more reporting and more impact measurement, but I think it's very patchy. I think some foundations or others have got very excited about this, and there's a whole movement called venture philanthropy that some of you may have come across, which is a very engaged philanthropy, and by engaged you could mean pain in the neck for the investee, because they're going to be on their back. They're not just going to give them the check and walk away.
On their board?
Yeah, on their board, demanding all sorts of things. But I think there's an argument how, if that's done well, it can actually be very good, because it brings stuff beyond the check to the people you're working with. The other question, just briefly, if I may, is a sort of existential question, but also a very practical one. I mean, from my point of view, I don't think there should be any social organisation that takes money that should not be accountable for its impact. I think that's a responsibility of claiming you're doing social good. And I think any organisation that doesn't choose to do that is failing a basic test of being a good organisation to me. Can I finish? And then you can jump in. Having said which, of course, measurement is onerous and difficult and costly. And for small organisations, it is probably unrealistic to expect anything other than a very limited level of reporting. But I don't see how any organisation that considers itself serious can not do something about measuring its impact at some level that's realistic to its scale and its projects and its stakeholders. I'll shut up.
No, that's fine.
Yeah,
yeah, I understand. So, like with the bank, that impact will be interest paid. Is that the?
Okay.
I find it's very hard with social product projects that the impact is measured in money. I mean, how? I mean, if it's a government-run thing, then governments will be afraid to.
Okay, well, it's very clear. It's not a government-run thing. So let's be quite clear about it. Big society capital is completely independent of government. So it is effectively a fund, a social investment fund that, of course, has been set up under government regulation and owes its origin to government legislation, but which will be, they assure me, and I know well the senior people who are running it, setting it up, will be independent. They will not have a minister on the phone or able to influence their actions or to recall the capital. So that's very important to understand. In terms of their own measurement system, they will have a strong emphasis on being sustainable. So the profits and the interest they might make on their investments will be retained. They have no external shareholders, and they won't be distributing profits anywhere else. That's critical for their mission integrity, if you like. So they won't be looking to maximise their returns as they would do if they were a publicly listed financial firm, because they'd be required to by their shareholders. They won't have that requirement. But they will be required to be sustainable over time, though I'm sure they will have a period where they're basically losing money for a while. They're bound to. But they will also have, but subsidiary to that, a series of social measurement parameters they're exploring. But their first agenda is to prove that within what they're trying to do, which is to capitalise investment in this space, they can be sustainable. So they can be there over time, to be recycling their funds to more and more value over time is their objective. Does that make sense? I don't know if that answers your question, but...
And,
yeah.
this is within the context of a big cultural shift in all of these blurred, boundaried sectors, which is very much away from grant dependency towards earned income. And part of that earned income also involves taking equity rather than, again, being grant dependent and writing one of those wretched grant applications every year to last for 1 year. So the question you ask and maybe the fear around the cost of evaluation and measurement is something which the social sector in particular has to take very much into account because change is here.
But I would put it in context. I think everything Cheryl says is absolutely right. But put it in context. You know, it's estimated that private social investment in Britain in 2011 was £192 million. And the same estimate projected £400 to £500 million of opportunity for private social investment. Okay, philanthropic grant giving in the UK, I think, don't quote me on the number, we're talking several £billion per annum of grant making, and that's not including government. So although the social investment sector that might be to some degree more like a for-profit investment is growing and getting a lot of interest, it is still tiny compared with the institutions of foundation grant giving and government grant giving, which are massive still in Britain. So it's growing, but it's a tiny proportion of all the money going into social organisations, if you like, in Britain.
And we don't have the same depth of philanthropic giving or a pool of philanthropic funds here, but we're only 200 years old. We're working on it. There will be 25 minutes for questions very soon. I've just got 2 more of my own. So just bringing together this notion of where money might come from and measuring impact is the concept of what's in the UK called social impact bonds. So for all you people interested in risk and bond markets, here's a new idea for you. In New South Wales here, they've been repackaged as social benefit bonds. The interesting thing is, though, that when they are announced soon, they were started under the Keneally government and have been renamed and continued under the O'Farrell government. We will be about the 2nd place in the world.
Yeah, you will.
Imagine that.
So this again is a kind of smart piece of innovation, really. So the social impact bond is a set of contracts, really, that are brokered by an intermediary. In Britain, it's an intermediary snappily called Social Finance. They're actually an organisation as well as a thing. And the contract is between government, third sector or social enterprise providers of services and private investors. And the point of the contract essentially is to recognise that early and substantial intervention in significant social problems typically returns an enormous long-term saving to the state. So rather than kind of drip-feeding interventions in things like early childhood support, in things like reoffending and reducing reoffending rates, rather than drip-feeding that, putting a significant investment in early pays a very significant dividend later in terms of savings. Now the problem with government accounting, at least in Britain, is they can't account over periods typically of more than a couple of years. Sometimes it's 4 years, maybe 5. They just can't, the Treasury won't let you go to the Treasury and say, give us some money because in 8 years we'll save you, $100 million. That's just not possible to do in government accounting. So this is a mechanism to allow government to essentially defer payment, but agree payment and to get the private sector to take the risk up front. So what happens in the pilot in the United Kingdom is that a set of private investors are supporting a group of organisations to scale that work with ex-offenders, people out of prison, to reduce reoffending rates. And if they reduce them above a series of hurdles, that will trigger, at the end of a time period, I think it's 5 years, for the Ministry of Justice, part of the government that deals with prisoners, to pay essentially the capital and a dividend back to the private investors. So the private investors get their money plus, the social enterprises get money in bulk now to scale their interventions. The government doesn't have to pay now, but if it pays later, it pays probably a significantly lower proportion of the overall savings than it would have had anyway by the intervention. So the government's also saving money over time and it's deferring the risk. So the first of these pilots is up and running in Peterborough in the United Kingdom with ex-offenders. 3,000 ex-offenders are being looked at, and they've only gone 1 year. So the first year's reporting on this looks positive, but we won't know until several years out. But the people in social finance who have put the project together are very bullish, but they think they'll, as they say, knock the ball out of the park on this one. They think they'll completely, maybe I shouldn't say this on camera, sorry Toby. Toby privately told me that they think that they will do very well on this contract. So I've heard. And the principle is, and to be honest with you, most of the private investors are actually foundations, but that's not surprising given this is the pilot. Yeah. They're confident that if they prove the pilot, and there's some track record of this in the UK already, real private capital will pile in down the line when the risk is understood, this mechanism.
Just before you ask a question, you can see why this is attractive to governments, socialising the risk. That there are so many intractable issues out there which have proven very hard to demonstrate significant change for the better in, and it's the sort of thing that the Daily Telegraph and other papers love to beat up on the front page, and that's a huge disincentive for governments to actually put money aside for this. So this is one of those solutions that actually I think it's a very clever solution if it works, and we'll be watching it. Your question?
Tell me why it isn't privatisation on the slide, and also pushing out a payment that the government that's almost bankrupt and can't afford now to 5 years hence, and then maybe making it someone else's problem then.
Well, I mean, to the second point is a contract, so it is somebody's problem, and it'll be paid. It's a legal contract, so if the hurdle's achieved, the government can't renege unless it wants to break the law, break its own law. Maybe that's conceivable, I don't know. So I think that's unlikely. Yeah, it is privatisation, yeah. I mean, there's no question it is. The argument here is this is capital that wouldn't be there anyway. So it's privatisation, but it's additional. Okay, so the government is not going to spend the money on early intervention, stopping reoffending for the reasons I've explained, because it can't budget for it. So you're bringing in money which would otherwise not be spent to address a social problem. Now, does that mean there are real, maybe even to the point you say moral issues about this? Yeah, of course there are. And of course there are, there have been significant objections to this model from the core third sector who find this offensive, and from people who are very worried about, exactly as you say, government essentially outsourcing its responsibility for action. And I think those need to be very carefully watched in the development of this bond. I think as long as we can demonstrate some additionality of investment, there is at least a case to make for this, because in the end, most reasonable people would prefer ex-offenders, kids in foster care, kids with serious problems at home, to have the largest amount of opportunity to be supported as is feasible. And if that involves to some degree taking some dirty private money, if it's well structured, then I think we shouldn't just dismiss that. But are there real issues here? Of course there are. And is it challenging to what we think of as the model of government or third sector provision? Yes, it is.
But I don't think you should assume that it's all dirty private money.
I'm not assuming that at all. I just wanted to.
No, but I think that's an absolute criticism. And in the pages of the kind of newspapers I read, you know, there's been a lot of commentary and concern about exactly what you described there.
It's an ideological thing. I mean, it's a Tory
Oh,
policy,
it could
right?
be a... No, it's not. It's a Labour policy. I mean, this is the irony. I mean, this was absolutely a core... I mean, as I say, this, the thinking of this was entirely Blair and Brown and the people around them. And what was interesting was how this was taken forward by the new government, the right-of-centre government or coalition government we have in Britain now, probably for different reasons. You know, I mean, the interesting thing about this whole social enterprise and social investment policy agenda is it seamlessly moved across government, where almost everything else was torn up. But when you look at the framing of what's going on, it's a totally different set of arguments. You know, on the one hand, you know, enhancing, extending government, on the other, reducing government. But same mechanisms, different
But the
ideology.
original idea didn't come from a politician.
The Young Foundation claim control over this, and they're a kind of think tank stroke policy stroke research group in Britain, and I'm prepared to give them the credit for this, but I mean, in work I've done, ironically, actually, the notion, without getting kind of too picky about this, the notion behind social impact bonds was actually floated by, earlier than the Young Foundation, by a Conservative Party policy document in 2006, which is sort of airbrushed out of history, actually, but it's there, in fact. But, you know, hey, a good idea is a good idea. I don't really care who's started it.
We didn't get up to social stock exchanges. They could be next time. I'd like to...
We might have one by then, you know, we don't have one yet. So.
I'd like to thank Alex Nicholls for spending some time with us tonight, and for Cheryl to do the interviews and help us understand this very complex area.